Good afternoon, good evening, and good morning to wherever you are in the world. Welcome back to another episode of the Coffee Hour, where we're going to be going over some stock market news, some macro news, all right, and we got some crypto news as well, and we got some ETF news, all right. So actually, we have some things to talk about today. One of the biggest ones I know is probably going to be one of the bigger topics. I think is probably going to be about the WPAY. WPAY. I thought about making a video on this specifically, but I don't know. Maybe I'll make a video. I have no idea. Because if I'm going to cover it in the stream, it's going to be pretty clear cut. I mean, there's there's really no extra sauce to it. So anyways, we do have some things going on. Let me quickly, because I forgot to do this. Give me 1 second. I'm being a bad host as always. There we go. Got to pause that video. Boom. We get that bad Larry, and we dump that into, I forgot to dump this link into the chat. There we go. Boom. All right, cool. So yeah, like I was saying, we have a lot of stuff going on. As always, I do appreciate you guys joining me. Happy Friday. Thank God it's Friday. All right. Weekend is here. Tomorrow, of course, spend a lot of time with your loved ones. All right. Get off finance land. But anyways, with that being said, guys, let's get into today's stream. All right. Let's get into today's stream. Let me close that. And we're going to go here, click here. Man, I am slacking on the stream today. Okay, so in the chat right now, we have El Patron Alfredo. I do like a good Patron from time to time. Good evening. Well, good evening to you, sir. We also have Sean. Hey, I'm back. All right, well, I'm back as well. So thank you for joining. I saw your chat earlier. So let's get it going, guys. I'm sure others will be joining us here shortly. I still got to figure out why X is not broadcasting anything. At least I don't see any viewers, or maybe I don't know, maybe my stream is just not popular on on X, because usually we'd be like up to like 50 viewers by now, and climbing when I factored in the X. Hey Gary, welcome back. Always appreciate you. And we got Skeptic in the chat. All right. Man, it's been spicy. It's been spicy. It's only going to get more spicier. So guys, I want to start us off with a little joke. All right. Not a joke, but a video, a parody. I think it's pretty awesome. All right. Hopefully it doesn't blow your eardrums out. And of course, like always, I forgot to show you guys, or I forgot to share the audio. So not this time. I'm double checking it this time. All right. Boom. All right. So we got that. I got to add that to the stage. All right, cool. Okay. Man, it's like 10 minutes of prep. Holy hell. Okay, let's go. So here's the video. I found this when I woke up. I thought it was pretty funny, so I just had to share it with you guys. All right, so here we go. So this is basically CZ of Binance versus Michael Saylor and, the Bitcoin fiasco.
No, no, no! Okay! 何を見ている?
The bottom, dude. Oh my God. That went so hard, man. That was so dope. All right. Skeptic also agrees, bro. I can't. Sailor The anime goes so hard, bro. It absolutely did. This video, and this is the creator, psyop anime on X. You guys can check him out, of course. But man, when I saw this, I woke up and saw it. I was dying. I was like, this is freaking awesome. Because man, this is probably how it really is. All right. Anyways, wanted to start the night off really good for you guys. Okay, so moving on, we got the S&P 500. All right, this is the heat map. We're going to just cover it really quickly. We see Microsoft, NVIDIA, Apple, Google, Amazon kind of leading the way down, right? Again, continued technology sell-off, right? Meta is also down. We have pretty much every other sectors, including software, seeming to get a huge bump, right? Semiconductors also did pretty well aside from NVIDIA and AVGO. So yeah, utilities, again, doing well. Real estate, I'm actually surprised real estate's doing well. So we have all these, we have all these other sectors, going green for the day. Now, the question is, did we end the week green, right? We placed a bet yesterday. We asked everybody in the chat, hey, are we going to be ending the week green? And we'll find out the answer here. All right. So over the last 5 days, we ended down. We ended down 1.17%. All right. But for today, we basically traded flat. All right. Only up 5 basis points, not a whole lot here. All right. But that's not the end of the world. All right, guys, that is definitely not the end of the world. But yes, we did end flat, or we did end down for the week, unfortunately. All right. So moving on, I again added this ETF, the IGV, to this lineup because again, I just want to know what's going on in the broader technology sector versus using something like a QQQ, which is the NASDAQ 100. So I added IGV. So we can see again, they were up today, which is good. And that kind of goes hand in hand with the heat map over the last 5 days, right? Not a whole lot, right? They weren't up by a whole lot. And again, the technology sector has just been absolutely getting pummeled. Software has just been selling off, right? SaaS apocalypse is what they're calling it, right? So over the last 6 months, since October, it's down almost 30%, right? Whereas the S&P 500 is really not that down, right? It's not down over that much over the last 6 months. I mean, if we look back in, let's see, October, I mean, we're down almost 1%, right? So it's just showing the resiliency of the S&P 500. It's showing the resiliency of these other sectors as money rotated away from technology, as we saw, money rotated away from technology, from software into these other sectors, utilities, energy, consumer staples, defensive, all that other stuff. So let's see. We also have, whoops, not that one. We also have Victor Senk. Hello, I still don't check market, but some people said that today MSTR had a good rebound, and that is the truth. MSTR did have a good rebound today. So did BMNR. All right, and we're going to be covering BMNR here in just a moment. Okay, so moving on. So we have Bitcoin, again, not really doing a whole lot. I really think we have to break that $72,000 range, or $72,000 dollars a coin, if we're going to push higher. If not, if it gets rejected, I think we're going to head for lower. We're going to head lower, point blank. I mean, I don't want to head lower, of course, but I kind of do because I want to pick up more IBIT shares. And I definitely added to my IBIT position as well as my BMNR position, over the last couple of days. Well, actually, no, BMNR, I added a bunch yesterday. And for Bitcoin, or for IBIT, I added kind of sporadically through the week. All right. So, yep, there we are for IBIT, or for Bitcoin. And if we move on, gold actually had a pretty good pump today. All right. Up 2.49% year to date, still the best performing asset. It still has not recovered to its all-time highs. Its former high, I should say, but it's well on its way. I mean, this is doing a lot better than what silver is doing. Silver is actually up almost 3% for the day. Year to date, you guys tell me. Some people believe that silver itself, the spot price, is going back to 50. Whether that's true or not, I have no idea. But that is what's going on. The miners, silver miners, gold miners, etc., they're starting their earnings season. So we could see, at least the silver miners, the gold miners, and things like that start to pump. So again, something to keep in the back of your minds. Okay, guys, let's get up to the big news. All right, the big news that everyone's been worrying or talking about. It's been making its way around X and definitely in Discords. It's probably going to be making its way on YouTube in the not too distant future. everyone's kind of hopping on this news because it is big news. All right, so Roundhill announces they are changing the strategy for WPAY. All right, if you guys don't know what WPAY is the weekly pay universe ETF. It's similar to like a ymax from yieldmax, which holds all of the funds that they have, or all the funds that they own. So Roundhill did the same thing for the weekly pay series. Okay, so they created this product called WPAY. But as you guys can tell, and I mean, I'll pull up a chart here. Let's see, WPAY, ETF. Let's see if it comes up. Yep, it works. Okay, so as you guys can tell here, I mean, we can look at Since and Snapchat not doing really all that well, right? Just it's been on a downward trajectory. But I mean, look at the time frames too, guys. You got to take that into account. This is October, right? This is the October sell-off, volatility all the way down, right? So this is obviously a very unloved ETF, right? In the high yield space, everyone started getting out of it. They say it sucks, blah, 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 etc. The typical high yield mindset, right? Buy things when it's going up and then not fully understanding what it does. And then when it goes down, because of the leverage that's in these products, right? It goes down even more. And then everyone's saying this ETF sucks. So, I have to always say that because that's what you see. But here are the changes that they made, right? Here are the changes that they made for WPAY. And this is a big deal. And I'll explain why here in a moment. But they're changing the fund name from WPAY to Roundhill Top Weekly Pay ETF, okay? From WPAY to Top W. They could have really had something with, probably, what was it, W Top, I think, or something like that, Skeptic. I think you mentioned it in the Discord. But here's some of the updates that they're doing, right? At least with the new ETF. Okay, so they're going to be changing the strategy. The strategy was that they would have all of these ETFs, right? Except for the macro ETFs. They didn't include these, but they would have all the single tickers: NVIDIA, Meta, Hood, Google, Costco, etc. Blah blah blah. Right? They would have all of these in a equal weighted basket, and that is how they came up with WPAY. But under the new strategy, right, under the updated prospectus, what they're going to do is, instead of just adding the entire basket, because you're going to have things like MSTW and coin, COIW, just dragging down the index, just really dragging it down, right? So what they're going to do instead is, unless these are in the top 25, the underliers, Apple, AMD, Amazon, ARM, AVGO, Alibaba, Berkshire, etc. Unless these are in the top 25, right here, as it says, they're following the top 25 constituents of the Selective GBS United States 500 Index. Unless they're in the top 25, they're not going to be added to WPAY, and this will be rebalanced on a quarterly basis. All right, this is big news, because if you look at the top 25 stocks right now for the S&P 500, we can see you're going to obviously have the Mag 7, but you're also going to have the Mag 10 in there, right? Broadcom, you have Tesla, but also Palantir is going to be in there somewhere. Actually, I don't see Palantir in here. All right, maybe it got kicked off, or this list is not updated. But anyways, you're going to have NVIDIA, Apple, right? So the Mag 7, you're going to have, Berkshire up in there. You're going to have Broadcom, AVGW. You're also going to have, they came out with, let's see, there's another one in here. Netflix, AMD is the other one, right? So they're getting rid of Coinbase and MSTW, right? Coinbase MSTR, excuse me. So they're getting rid of those. So this will probably, shave down some of the really bad underperformance, that WPAY has had. But again, this is going to be like rebalanced quarterly, right? So you're not going to also have UNH in there, right? I don't think Uber was in the top 25 as well. Yeah, it doesn't look like Uber was in the top 25. So again, they're getting rid of some of the I'm not going to call them smaller companies, because I mean, these are pretty large companies, but they're getting rid of the companies that don't fit the list, right? And this is all based on a market cap. Okay. So this is really what I think what they should have done initially, when they came out with the WPAY and they said it was all going to be equal weighted. I mean, I thought it was a good idea as well, but I think if they had went with a market cap weighting approach, meaning that, like the underliers with the largest market cap would get the most weighting out of a possible 100. I think WPAY probably would have fared a little better, from this downturn that we've been experiencing, especially because, I mean, you don't have to look very far. Look at the S&P 500, right? Just over the last couple of months, it's been doing pretty well. I mean, it's been kind of volatile, really choppy, but overall it's been pretty well, right? Whereas everything was equal weighted, with WPay, and just everything went down. But of course, you have to factor in the leverage, right? The 120% leverage, it cuts both ways, right? Everyone gets super excited when it's going up. Not everyone gets super excited when it starts going down, right? So you have to also take that into consideration, because all of these ETFs have a little bit of extra leverage. So again, I think this is a good change for WPay. I still hold WPay. I've held it throughout the entire duration, since I started a position in it. I did trim it about, I think, 40 or 50%, which gave me the powder to basically open up a gold position. But I still think WPay is still an excellent product, all things considered. It's, again, people don't like seeing red in their portfolio, not fully understanding the product. I think this is a good change personally. And again, like anything for me personally, this is, again, just me personally, anything above 30%, I'm happy with. At one point, this was paying like, I think 50, 60, 75%, right, during the good days. Then October came around, and then November, and then everything kind of just sold off, right? But anything above 30% for me, I like, right? I'm not hating on the ETF. So anyways, that is the biggest news for WPay. All right. So I don't know if this, we'll find out very soon. I think getting rid of, things that drag it down, things like, I wouldn't say ARM. I don't know too much about ARM, like personally, but I wouldn't say ARM. I would definitely say Coinbase and MSTW have been dragging it down like crazy. UNH had a pretty massive sell-off recently. Let's quickly look. And of course, all of that translates into WPay. Like if we look at the last month, look at this, right? Down 20%. That is obviously having an impact on WPay, right? So this is why, it would have made better sense to start with a market cap weighting approach in WPay. But they went with equal weighting, and then they would rebalance later. But with this new approach, I think this will probably be a net positive for the ETF and for shareholders, in my opinion. All right. Like I said, I'm kind of biased. I hope, because I hold WPay and I have a decent chunk of change in there, so I'm hoping WPay will pay off in the long term. And, I'm just going to keep holding it. I'm not going to sell out of it. The thing with these high yield products that people don't take into consideration is, the tax consequence. Now, I'm not talking about the distributions, the ROC. For those on Robinhood, you guys got your 1099s. I would recommend you take a look at those 1099s. I was pleasantly surprised by some of it. But anyways, going back to why I wouldn't sell these and making the mistake of selling them in the past, when your cost basis goes down, right? Because every distribution they're paying out from the NAV, right? That's bringing your cost basis down. If you have a gain, or if you hold the ETF long enough and your cost basis, reaches these super low levels, like almost close to zero, and then let's say you're still up on the ETF and you sell, well, you're going to be incurring a pretty decent tax consequence. Whether you care or don't care, it's up to you. I'm just voicing my opinion here. Like people who are tactically trading these, that makes sense. But people would be like, oh, I'm going to do a dividend capture strategy on these, right? Like, if they're taking the dividend out of the NAV and it does not appreciate in value more so than what they paid out, then you're effectively getting paid zero. You're effectively walking away with nothing. The distribution, the dividend capture, is literally the ROC, right? It is your ROC. You're not doing anything, right? You're not making anything. So that is the way I understand it, right? Feel free to disagree with me. I definitely would welcome any outside opinions, right? But that is just the way I understand it. You could trade these, but you got to be careful on how you trade them, because you want the ETF to go up, right? You want the ETF to go up. And when you trade these, you're opening yourself up to risk, because if the ETF goes down, you collect the dividend, it goes down even further, and now you have to wait for that recovery, right? So you have to wait a little while. So anyways, that is that for this WPay section. Again, I think this is going to be a big deal. Let me just quickly check the chat. I see some of you guys are talking over here. We got international funds being mentioned. Let's see. Yeah, I agree. These changes wouldn't have helped last week or this week since the Mag 7 was crushed over the last 2 weeks. That is true. That is true. But again, it's not always going to be like this, right? It's not always going to be this way where the Mag 7 is constantly selling off. At some point, we are going to have a rebound and we are going to reach new highs. How long that takes, entirely debatable, right? I'm still very bullish for the rest of this year. I don't know if this is the bottom. I don't think it is a bottom, right? I think we're probably going to have that really dreaded, I don't know, 15%, 10 to 15, maybe 15 to 20% drawdown at some point during this year. I don't know what the catalyst could look like. Maybe the Supreme Court rolls back the tariffs and then, the market sells off, or maybe the market pumps. Who knows, right? Maybe we get, Kevin Warsh in the seat at the Fed, and then he says, you know what, I'm not hiking rates. He goes against the Trump administration's demands, and then the market takes a dump. I don't know. Like, nobody really knows where the market is going to be, but it would be prudent to at least have some dry powder in case something does happen, like a huge sell-off. So I mean, good point though. Very good point, Wolf. Let's see. So we have Skeptic mentioning a bunch of international funds. Definitely check those out. Some more funds, international, of course. There's no type of support anywhere by a chart on WPAY. Why does this keep falling to never bounce? Well, again, Michael, like, when you're looking at WPAY, and again, I'm not a chartist, I'm not a technical analyst, but you don't want to use WPAY's chart as, for technical analysis, in my opinion. And the reason is because it's holding a basket of these individual tickers. Okay. All these tickers, right, have their own charts, all the underliers, right? Apple, AMD, Amazon, ARM, Broadcom, Alibaba, Costco, and Palantir, Tesla, etc., MSTW, right? So it's like you can't really chart WPAY, right? You can't look for a breakout or anything, or resistance or this or that. Just in my humble opinion, right? I'm sure there's probably some better people out there with that do technical analysis that might have a contrary opinion, but it's just my opinion that you really can't do technical analysis on WPAY. Why it keeps falling and never bouncing? Well, again, I mean, we just kind of discussed it. You have companies like UNH, MSTW, Coinbase that are really dragging it down. You had Microsoft. As a matter of fact, let's take a look at Microsoft really quick. You had Microsoft that had a really big sell-off, right? A 10% drop. And when you factor that into WPAY, what do you think that is for WPAY, right? Look at that. That's 18%, almost 20%, right? What do you think that is for for the underlier, MST or MSFW, right? You stack on that extra leverage, it's going down even further, right? If it fell 10%, it fell 12%, in the weekly pay series. So again, you're going to have volatility decay. You're going to have that path dependency problem. All of these ETFs are going to have those same risks, right? And WPAY is a basket of risk. So you want to buy in an up market, right? Or if you like the series, if you like the underliers, you like everything about it, maybe that product fits your bill. For me personally, like I said, I'm a big fan of most of the holdings here. UNH, not so much. Uber, I could care less. ARM, I like ARM. From what I know, I like ARM. They're in this, semiconductor space, so I definitely like them. Everything else for the most part, pretty good, right? They really need to add Walmart to this. Walmart would be, I think, a pretty good one to have, because I mean, we just saw what Walmart has been doing. BABA, they just got added to the Pentagon's. Basically, they got added to the Pentagon list, which identifies companies that are serving the Chinese military. That's not a good list to be on. It would not be far-fetched to think in the future, because the United States has threatened this before, to basically kick off Chinese companies from trading on the stock exchange. So again, there's a little bit of risk there, right? A little bit of risk. So anyways, yep. And then so Working Investor actually has a pretty good video on it. I disagree with some of it. I'm going to be honest, TWI, but I do disagree with some of it. But again, you do bring up some pretty good points. WPay has broken leverage more than 1.2x down and less than 1.2x up on average, based on my analysis I did a while back. Of course, you guys can go and check out his video, his YouTube channel. I think he did a pretty good video. One of the things people are not taking into account when it comes into the weekly pay series, and this has to do with the strategy, the swap agreements. There's a fee. Right, they do it through Nomura Securities. All right, so there's a fee every time that they do these swap agreements. A lot of leverage funds do business with Nomura Securities. But what was I saying? But yes, there's that fee. So that fee also adds on the drag, right? Also adds on the drag of this of these ETFs. Again, I mean, people can come to their own conclusions, do their own research. I think, by and large, it also depends when you buy these things, buy these products. Okay. People will pull up a chart, right? They will say, oh, since inception, blah, 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 compared to plty, blah, 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 yield max and Roundhill and reits, right? Oh, but all of that should get thrown out the window. I personally really think a lot of that should get thrown out the window, because one, it counts when you buy. And if you dollar cost average into these, right? If you're DCAing, you're screwing up not only you're screwing up the position, because now it's going to have additional volatility decay, etc. Your cost basis gets screwed up. The cost basis gets screwed up. There's other things that just go wrong when you start dollar cost averaging these. Like, I am of the belief if you're going to be in these weekly pay series ETFs, it should be a really big lump sum and wait for a bigger pullback if you believe in the underlier, and then drop back in. That's just my opinion. All right. Okay. So anyways, let's move on. Actually, let's see what else we got. YMAG is better than YMAX, says Sean. So the change should help in the long run. Let's see what else we have here. This is from Gary. If the WPay distributions picked up over time, it should help, even if the price doesn't fully recover. Well, that's you got to be careful with that, because the distribution is coming from the NAV. Okay, the distribution's coming from the NAV. If it's going down, then the ETF itself is going to go down more. Okay, because you're going to have that distribution come out. So the share price is going to continue falling. Like, if there was $1, let's say a dollar, a hypothetical $1 that gets pulled for a distribution for every share you own. Let's say the W pays at $50. When it pays you that distribution and it goes ex dividend, it's going to drop to $49. Now, let's say it just keeps dropping, right? So that's why, and it pays every week. That's why you got to be careful with ETFs that do weekly distributions, or at least that's one of the pullbacks I would say. So Michael says, I couldn't buy WPay and I don't understand the fund is one reason that I like AI or tech selling off. And until the bottom is that I can't buy. I get your points, and that's excellent. Waiting for tech to sell off. We have something coming up towards the end of the stream, which I'll cover. All right, guys, I've been talking about WPay for a good amount of time. I definitely want to get on moving, because we got some other news out there. All right, but yeah, that is the biggest news with WPay. That is kind of my thoughts, my commentary on the changes for WPay. As a WPay shareholder, I'm pretty excited about that. I am definitely with that. All right, so moving on. BlackRock buys up BMNR shares as Ethereum threatens to fall to $1,400 in price. And this just came out. Okay, this just came out. They actually announced it yesterday, Thursday, if I'm not mistaken. So people, again, on X, everyone's talking about BMNR is going to get liquidated. Tom Lee's a scam artist, it's a Ponzi scheme, just like MSTR, blah, blah, blah. Well, why would a big asset manager like BlackRock decide to just buy up BitMine, right? Think about that for a second. So, BlackRock did buy up BitMine, so we're going to cover it here. There's a lot, like I said, there's a lot of clowns just everywhere. You got to be careful what you put in your head and what you read. Some of it is good. There are legitimate bear cases against BMNR, and they're logical. They're based in logic. But when you have people shouting just nonsense, that's where you got to be careful. In my opinion, that's just how I approach a lot of this stuff. All right, BlackRock is doubling down on Ethereum by buying up more BitMine shares during the market dip, the firm disclosed on Thursday. the asset manager's Bitcoin holdings surged 166% to $246 million in the fourth quarter of 2025, according to a 13F HR form filed with the SEC. All right, so scrolling down, I got to really change this color. All right, there we go. Still bullish. All right, this is coming from BlackRock. Poor market performance isn't denting BlackRock's conviction in the second largest cryptocurrency, i.e. Ethereum. In January, the firm said that Ethereum will lead the tokenization of real-world assets. We already see that with Robinhood coming out with Chain, right, where developers can start tokenizing assets on their blockchain, which uses Ethereum and Arbitrum. It cited the fact that some 66% of all tokenized assets are on Ethereum, dwarfing Binance's BNB chain ecosystem, which only commands 10%. It's behind Solana, Arbitrum right here at 4%, Stellar Lumen or Stellar at 4%, and Avalanche at 3%. Okay, this is a big thing right here. In January, BlackRock CEO Larry Fink, who's been very anti-crypto for a very long time, but now BlackRock has the IBIT ETF, which is the most successful ETF they've ever launched, described tokenization as necessary while speaking on a World Economic Forum panel in Davos, Switzerland. All right, so you have the CEO of one of the largest asset managers out there, managing trillions of dollars, not only bullish on Ethereum, but also bullish on BMNR. All right, adding BMNR to their stakes. So again, guys, I mean, I'm not saying you should buy it at all, but it is gratifying to see news like this because again, last week it was nothing but FUD. Like it was crazy amounts of FUD. MSTR is getting liquidated. Sailor's a scam artist. Blah blah. Now there's a new one coming out, right? Strategies. Mysterious Class B shares, right? That one is also coming. I should actually do a piece on that. But now there's new FUD coming out that Michael Saylor has these mysterious Class B shares. They've always been there, right? They're secondary actually they're not secondary. I shouldn't say that. Common share MSTR, right? So you have common share MSTR. That's what you buy, and then you have Class B shares, which nobody can buy, and that is Saylor's literal like share count. That's what he owns as part of MSTR. People are saying like, oh, whenever you buy MSTR, this allows Saylor to get free Bitcoin, right? Because as MSTR buys Bitcoin, Class B shares, which are owned strictly by him, he gets free Bitcoin. So for every amount of certain shares, blah, 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 this is how much Bitcoin he gets for free, which is a total lie. Michael Saylor has said publicly that he does not have the crypto or the Bitcoin on his own private wallet. That's one. Two, it's with a lot of custodians. And three, he's been diluting MSTR. So what do you think that does to Class B shares? That dilutes the Class B shares as well. And the Class B shares, he cannot create additional Class B shares. So while he's been diluting MSTR shares, Class B has been going down as well. The only benefit to owning Class B is that for every vote, for every one vote for MSTR, there's 10 votes for Class B shares. All right. So it's a little research in case you guys want to do that research. But it's just more FUD, right? More FUD, nonsense, right? And again, people coming out attacking Tom Lee, calling him a scam artist, et cetera, et cetera, et cetera. If you have done any type of research on Tom Lee, you would know that he is by far probably the least person to scam the audience or scam people in general. He's been labeled a perma bull. I mean, how could you not, right? The stock market is pretty much designed to just always go up, right? As more money floods into the market, as more investors invest, et cetera, right? It's just, that is the way it's designed. It's designed to go up. It's not designed to go down. It's just whenever it goes down, it's, either a market cycle, a business cycle, or investor sentiment or some type of catalyst. Okay. So those are just my thoughts. Long rant here, but again, I just get so sick and tired of like reading X and watching YouTube and like looking at comments and just people spreading so much nonsensical FUD. Like it really does get annoying. Anyways, hold on. I got to take a cup of coffee. I got to take a sip of coffee. All right. Give me a second here. Okay. So we have, how do you see MSTW playing out for it to go back to the 30 or $50 range would be epic. So I'll say this is my own conviction. MSTR is going to have this crazy parabolic move up when Bitcoin does. And when it does, I don't know what the price targets are going to look like, right? Because you gotta think of the leverage. So for me personally, let's see. For me personally, I mean, we could do some quick math. Let's take a quick sidebar. We could do some quick math here. So MSTR is, let's see, MSTR stock price. Because I've dealt with this myself, right? So like I'm like, oh, I wonder how much it would have to go up, right? If we look at the 1 year, right, this is the last all-time high. Okay, scroll down 70%. Okay, if we look at MSTW, we look at the 1 year. Well, I guess we should 5 year. That's the same thing. Okay, so 1 year. We look at that, down 84%. Okay, so obviously it's down more because of MSTR being down more. In order for it to get back to that range, I don't know what kind of rip it would need to the upside. But I do know that if MSTR, because of people are putting out some price targets for MSTR, and these are Wall Street analysts, they're putting out price targets for MSTR, 500, etc. So if it was to recover, I would assume that this, MSTW would recover along with MSTR. For it to get back to the $30 price, I couldn't tell you. You would have to do, some quick math, whatever, let's see. So to get to 14% or to get to $14, let's see, $15. Let's see, that's why. Anyways, I can't do the math at the top of my head. Plug it into ChatGPT. It'll tell you, how much you need MSTR to rip in order for MSTW to recover to your price range. But yes, my conviction is that there will be this really crazy uptrend for MSTR. MSTW is obviously going to follow. And either two things will happen. One, people who held on to MSTW will look like straight degenerates or geniuses, or two, the fund gets liquidated, right? And we all look like idiots, right? Either way, we're going to find out, right? I hope it's the first part. So I hope it's the first part. Anyways, Tom Lee's Granny ETFs. Granny and Granny I do like. Yeah. I mean, again, Tom Lee has some really good funds. So again, these attacks on him personally, and BMNR, people equate price as like the end all be all, right? Whatever happened to, buy low, sell high. It seems like that just gets lost with people, or investing on conviction or a thesis. That just seems to get lost from people. So, when I see things like this, large institutional ownership in companies I'm, looking at, or companies that are coming under a bunch of FUD attacks, that's bullish. That's really bullish in my opinion. So let's see. I have Stretch preferred shares, 11% plus. I like it. It's starting to trade stronger and close to par, $100 independent of MSTR. Yeah. Saylor has just been going on this huge spree, this huge, TV spree, doing interviews and this and that. And he's trying to pump up Stretch as the premier product. I think he's mentioned it before as well, that if he could have started off with Stretch, he would have been happier. But now he has just a bunch of preferred shares. He still has a convertible debt that he has to service come 2027, 28, 29, and 30. But yeah, he's been really happy with the Stretch. He's been talking a lot about it. He keeps trying to bring it up in interviews and conversations. Stretch, I mean, if that's your thing, I think it comes with an 11% ROC, return of capital. So that's a very favorable tax classification in my opinion. That's what a lot of the high yield products offer. And people are like, oh, you get paid your own money back. Rah! But the intelligent person is looking at that and being like, hell yeah. Like, especially if you're a high earner, you don't want to increase your tax burden. But anyways, all right, moving on, guys. Let me get out of this MSTR. You guys got me going for WPAY. You guys got me going for MSTR and BMNR. Let's move on. All right. All right. So we had some big news come out about CPI. The CPI data came out, and just like normal, the stock market again sold off. Right. It pumped a little bit. It did have a pump in the early hours, but then it just kind of sold off again. I would not be surprised, because if you haven't heard, people are coming out and saying that the jobs numbers were fake, right? Or misleading, or not fully truthful, whatever you want to call it, right? There was a couple articles that came out, one from Fortune, basically saying that the numbers looked incorrect, and the market, right? The market is looking at them like, okay, so maybe CPI information is fake too, right? But anyways, let's listen in on this real quick blurb from CNBC on the CPI information. This is really important. Of course, has to do with inflation, all right, and where the Fed could potentially go. So let's listen in on this.
Bucks, we are waiting for the delayed CPI, and it is just crossing. And an upside surprise here, or a downside surprise, year over year at 2.4, had been expected at 2.5%. And I think one of the reasons is this rent of owner's equivalent rent coming in at a relatively low 0.2%. Energy down 1.5%, gasoline down 3.2%, new vehicle sales up 0.2. I am looking for the core number, CPI year over year 2.4, export energy, that came in at consensus plus 2.5%. And real earnings were pretty good, up 0.5% after declining in the prior month. So this looks like a good CPI number. You did have, by the way, a tick down in yields, as you might imagine. They were down at 4.10, now they're down 4.07. So a relatively big move in the 10-year. And let's look at what happened to stocks. They were negative going into this number. I think this gives the Fed some leeway here. I'm going to try to look at the individual sectors here, but it looks like this is overall a very tame CPI. The fear going into this, Kelly, we've had 4 Januaries in a row of upside surprises or a relatively elevated inflation. This would be the month where price increases are passed along. It didn't look like that happened. What I was unable to look at and what I will look at is the goods category.
So let's show 407. We were at 420 on the 10-year on Wednesday morning after that jobs report. Just show everyone, if you can, in the back real quickly, the whole Treasury complex, because again, on a week where we've heard that David Einhorn is betting on lower short-term rates, you just heard from the Treasury Secretary saying this is hopefully the game plan, that you can have a strong economy and low yields. And a weaker than expected CPI now has the 10-year at 408. So we're starting to look back at that 4% level. We only briefly went below back in October of last year. And the 2-year is falling as well, as you can see, down to 341. Steve, quick last comment, very quickly, on the Fed.
Yeah, I'm looking at this commodities sector. This is the goods sector. And we're just not seeing the pass along that people expected inside the goods that might be tariffed here. So maybe we've been there, done that. We did have an increase in those goods from tariffs. And maybe we're at the point where that's a done deal now, which would be a very positive development. And just looking up, the energy complex helped, food up a little bit. So medical care costs up a little bit, but it was that shelter number coming in at 0.2 that really, I think, helped the overall.
That is insane. You guys see this right here? 10-year Treasury down to almost 4%. I've not seen the 10-year Treasury down to 4% in a very, very, very long time. That is absolutely crazy that this CPI is causing this. That is really good. All these red going down, that's good. Like, you want to see that for treasuries. That is really good, especially for, things like real estate or commercial real estate. Because these influence the rates for those, like the 30-year influences the rate for mortgages. You obviously want that going down. It allows home buyers to, actually get a chance to purchase a home and not get killed by the debt. And then you have, the 10-year Treasury. This is more so for like commercial real estate. Most commercial real estate loans are good for about that time frame, either 10% or even the 5-year. Not so much the 5-year. That's not true. It's mostly the 10-year that they use. So this is a good sign. This right here is really, really good. So CPI is down. We'll see how the Fed reacts. We'll see. The Fed has to, the Fed, Jerome Powell is going to speak again in the future. So this is a good reading. We definitely needed this because this whole week has been nothing but bad, right? Well, we were up, but, more or less, we're still recovering from last week when we had a really bad sell-off. All right, so CPI consumer, just for a quick summary, consumer prices rose 2.4% annually in January, less than expected. So that's really, really good. The consumer price index, or CPI, in January accelerated. They use that word accelerated, right? 2.4% from the same time a year ago, down 0.3 percentage points from the prior month, and the lowest since May of 2025. Excluding food and energy, the core CPI was up 2.5%. Economists surveyed by the Dow Jones had been looking for an annual rate of 2.5% for both readings. The lower than expected reading helped boost the outlook for the Federal Reserve interest rate cuts in the future. All right. So we kind of already went through this. That pulled the inflation rate down to where it was a month after President Donald Trump in 2025 announced aggressive tariffs on U.S. imports. So that is a big deal right there. And then we have lower than expected reading helped boost the outlook for the Federal Reserve interest rate cuts in the future. Traders raised the odds for a reduction in June, again, right around the time when Powell gets out, and then hopefully Kevin Warsh gets in without too much trouble, to about 83%, according to the CME Group's Fed Watch tool. All right, so big deal here. All right, with the conflicting economic signals, the Fed is widely expected to stay on hold until June after a rate cutting cycle that saw 3 reductions in the later part of 2025. That's why you have Goldman Sachs, analysts basically predicting or forecasting 3 rate cuts, maybe even 4 rate cuts this year, which is absolutely crazy because you have the Trump administration constantly saying that they want to lower rates, right? Yet Scott Bessent, who was recently at a hearing, he was also mentioning that, once we get Warsh in the seat, that, they're basically going to cut rates. That is just the way it is, right? Or that's just what they're aiming for. Kevin Warsh, who is likely to push for lower rates. Treasury Secretary Scott Bessent on Friday told CNBC that he sees an investment boom acting as a tailwind while inflation gets back to the Fed's target in the middle of this year. We've got to get away from this idea that growth automatically has to be tampered down because growth per se is not inflationary. Bessent added, it's growth that leaks into areas where there's not sufficient supply, and everything this administration is doing is creating more supply. Again, guys, no politics in the channel. I don't care if you're red, blue, green, MAGA, or woke. I could care less. I'm just an investor reporting on the news, adding my commentary. I just want to make a buck, okay? And we got to cover kind of the macroeconomic news because it is important to the stock market. All right, so I just have to keep mentioning that because, people, time to time they'll be like, oh, you're a MAGA supporter because you mentioned Trump. It's like, no, that's not the case. I promise you that's not the case. And that's not a dish at anybody. It is what it is. Like, it's just a very heated environment in politics land. And that's why I personally avoid it at all costs. All right. So moving on, Trueflation, U.S. employment index, again, going back to that report that, people are saying that the numbers were fudged, the numbers are fake. This is Trueflation, all right? And you guys can use Trueflation, sign up for free. It's, I'm not sponsored or anything, but you can use this. They also have one for inflation. We see inflation is below 1%. Okay. And this is why the administration is pushing for rate cuts because this is, whereas the BLS that publishes this CPI data, this is backwards looking. All right. So this is information that's already old. Trueflation uses live data in order to come to this number. Right. So I was curious, and they actually do have one for employment, and the employment numbers from last reading, people are saying that the numbers are fake, but you can see here from November to December, the number went up, right? The numbers went up. Of course, from December to January, the numbers went down, but that was not for that reading, right? We'll get these numbers later. So again, I think obviously the economy is moving in the right direction now. Is that what, just normal Americans are feeling, everyday Americans? Probably not. There's an argument to be made that, probably some groceries are still expensive, right? Jobs are hard to be found. Just because there's new jobs available doesn't mean that a person would want to work that job, right? A software engineer is not going to want to work at like a Target, right? He going from making 150K, 200K to making $825 an hour, right? So just because jobs are available doesn't mean that, those jobs are going to be filled. You still have a huge amount of layoffs happening, especially in the software sector, because you have AI coming in and just wrecking up the place. You have AI that can build out apps, software, do all your coding. What need is there to have a team of 100 or a department of 100 software coders when you could just have an AI bot just do all of that for you? So that is the real thing. That is what's happening right now. All right, we have Goldman Sachs CEO David Solomon in the news, and he basically offered some thoughts on the macro setup for 2026. So I thought this was a really good interview. I just want to show to you guys. I think it's important, especially because if you are trying to set yourself up for this year, he does bring some good insight. So let's take a listen in.
Right to our next guest here at Pebble Beach. David Solomon is chairman and CEO of Goldman Sachs, and you're killing it, David. It's been 8 years
It's we're in the eighth year, Joe.
I think there were a couple of years where maybe you wouldn't have wanted to be out here at a golf tournament, maybe.
Yeah, I mean, there are times when I think it's great to be out here, and there are times where you got to have your head down and focused on.
I mean, I'm looking at
the matter at hand.
Every metric. Goldman Sachs is up in market cap.
I'm really proud of our team, Joe. It's been a real journey, but we've really worked hard as a team to grow the firm. And as we've grown the firm, we put more financial resources in front of our clients. And we've grown our client franchise, we've grown our market shares, we've grown the earnings of the firm. And when you grow the earnings of the firm, the market cap follows. And so we've got extraordinary people at Goldman Sachs. They've done an extraordinary job. And we're very excited. It's a complicated world at the moment, but we're very excited about the opportunities for our firm.
In so many ways,
looking forward.
Complicated, David. I mean, do you need to hire a bunch of young people to tell you what to do with AI? Are you ready to face the future in how to steer Goldman Sachs into this world?
Well, like everybody else, we're adapting to change in the future. And one of the things I know about organizations is organizations hate change. But one of the responsibilities for leaders, in organizations is to figure out how to help organizations evolve and change. Young people, young talent is always going to be a huge core part of Goldman Sachs. And, the way they work and the way they're trained has been evolving over the 40-some years that I've been doing this. You think back to when I started, there were no computers.
Yeah.
We were in the library, we were in microfiche, then we got a desktop computer.
A pager, if you were lucky.
I didn't get a pager until the 1990s.
Yeah.
Back when I started,
you could go to a payphone and find some change to return the call.
I'd be on business trips and I would get a page, with a little, analog, number, showing.
Nice.
You have to go return that phone call. And so the world evolves, people's work changes, but, talented, motivated people that want to serve clients are always going to be a part of professional services businesses, but the mix will change. The number might change. How they focus their time will change and evolve, but that's not inconsistent with what's been going on, for the last 50 years and longer, candidly.
What's 2026 look like for you?
The macro setup is quite good. I've talked about this extensively, including when we were together in Davos. You have this combination of strong fiscal stimulus, here in the United States. And by the way, in most developed economies, you have a pretty significant capital investment surge around AI and this technology, which is obviously, very, very stimulative to the economy and to economic activity. We have a huge deregulatory swing, in the U.S., which is also constructive because when the regulatory pendulum swings hard the other way, people have to invest more in meeting those regulatory obligations. And when it swings back, there can be more balance in that. And therefore, those resources can be freed up to invest in, more productive parts of the business. And so you're seeing that swing. That's a tailwind for economic activity. And so, we're sitting in a place with a pretty constructive environment. And I personally think if you look at Jan Hatzius, our economist, he's got 2.9% real growth this year, 5% nominal. And just kind of the consensus, and that's on the, the higher end of the consensus of all the economists out there. But the consensus as I talk to people is that we could see better than that. So you've got really strong tailwinds for good, nominal and real growth. And I think a lot of deal activity. I heard Jimmy talking about deal activity. I agree 100% with what he said about the fact that we're in an environment where if people kind of imagine something strategic, they can at least go have a discussion about it and see whether or not it's a possibility. And that's not the way it's been for the last 4 years.
You remember days when there would be an IPO every couple of days that we'd be talking about?
I remember those days. You can look at a period like 2021 when there was sponsor activity and SPAC activity and there were IPOs every couple of days. You can look back, at the 1998, 99, 2000 period. I think we're going to see more IPOs this year. I think we're going to see potentially some very, very large IPOs, unprecedented in size. But I do think I'll never say never again because, never's a big word and cycles run. But structurally, at the moment, smaller IPOs require, more discount, more patience, just because people want to put capital work. There's so much capital in the world that, smaller companies, it's always more attractive to sell a company for 100% of its value and get that cash today, privately, than it is to sell 10% or 20%, wait 6 months, sell another 10 or 20%, wait 3 months on it. So, that balance, comes, at different points in time. And at the moment for the smaller IPOs, they can be done, but there's headwinds.
But smaller investors are left out. The only people in on all these great Silicon Valley, on the future, it's all private. And by the time it comes out, it's already fully valued, it seems like. It's not fair.
I agree with you. We've got to find ways to have broader participation. I do think the SEC, I've met with Chair Atkins, and I do think he's focused on these issues and focused with doing a bunch of things that can create more momentum for smaller IPOs. And I think that's important. Our capital market system is the best in the world. And one of the reasons it's the best in the world is because we have a risk culture here where people want to participate in this growth. They want to participate in the growth of the economy. They want to participate in tech innovation. And those are things that we should kind of protect, nurture, and invest in to keep that differentiation here in the U.S.
Why, with deficits, if you believe the CBO, spiraling into the future, why is the bond market not more agitated? And do you think that growth and some of the policies that big beautiful bill, deregulation, whatever you want to call it, can we grow out of this to some extent?
Well, there's one thing that I believe for sure, and you've heard me, and we've talked about it directly. You know, I have real concern for the continued level of deficit spending and the growth of the deficit, the debt and the deficit. The only way we can get to a better place is to run for a period of time with higher growth than we've been running. I think we're positioned now where we have a chance for the next couple of years to run at a higher base growth rate, which will help, obviously, and I think is important. But when you say the bond market's been a little bit benign, I'd just say, we've cut interest rates by 100 basis points, in this cutting cycle, and the 10-year really hasn't moved, for all intents and purposes.
But it hasn't skyrocketed.
It hasn't skyrocketed either. Look, we have a lot of latitude. There's a lot of talk about the dollar. And, at the end of the day, there aren't great alternatives. And so given how important the U.S. is in the economic ecosystem of the world and the dollar is in the economic ecosystem of the world, we have more latitude than other nations to do this. But I do believe if we don't get it under control, we don't get our growth rate up, there will be a moment in time where we have, speed bumps or shocks or things that force us to readjust our behavior.
Well, what do you guys think?
We have a chance.
What do you guys think, right? First and foremost, before I even continue on this piece, I see in the chat that we have, again, people offering, thoughts on other ETFs, and that I think is super cool. I think that is cool because that is what we should all be doing, right? We should just be helping each other, figure all this out. So I think that is really cool. So shout out to you, Sergio and Remark, for having that conversation. Again, really appreciate you guys just interacting in the chat and kind of, helping build, kind of this community, right? Because that's what it should all be about. But anyways, going back to kind of what David Sachs was saying, or excuse me, David Sachs, Solomon. Yeah, excuse me, David Solomon.
Next couple of years.
Going back to what he was saying, I just had some notes here that I wanted to go over. Actually, we can keep this up. So Solomon sees strong macro tailwinds in 2026. All right, so big picture things. We have deregulation, right? He mentioned QE. He mentioned artificial intelligence, fiscal spending, AI investment. This is going to fuel earnings, which is a good thing, right? This is good for the stock market. Obviously, deregulation is going to free up a lot of capital for just growth. So all the names getting kind of punched right now, especially in the software sector, they could rebound and they could rebound even higher, right? He mentioned that Goldman Sachs expects 3% real growth or 5% nominal, which is a big deal as well for the economy. He also mentioned IPO and M&A. M&A is mergers and acquisitions. IPO is initial public offerings. So real quick, a merger and acquisition, M&A, is usually when another company takes over another company. So he's saying that, they should start to see more of that come 2026 as, cheaper debt markets and things happen. IPO, we saw a lot of IPO activity last year, and it was silent for a very long time. It was really, really silent for a very long time. There was almost no IPO activity for at least a couple of years. So now the IPO market is picking back up. More companies want to go public. Some of the biggest names that want to go public: SpaceX, Anthropic, creator of Claude AI, they want to go public. OpenAI wants to go public. You have some of the biggest names that fit into this, AI thesis, this, AI narrative wanting to go public. Elon Musk's SpaceX, merged. They did an M&A. So Elon Musk basically bought the company from himself. SpaceX wants to go public. That's a big deal, because he wants to do the whole data centers in space, thing. And he's on this whole other tangent. But again, maybe, we'll see. We'll see. But I think that is really a really big deal. We'll see if Robinhood, for any people on Robinhood, if we'll get a chunk of the shares that go IPO. I don't know if I'll be buying anything related to these companies because I don't want to be used as exit liquidity. I'll probably let it kind of simmer for a little while, let it, marinate, let it season a little bit, because usually when these big companies end up going public, you have all of this money that wants to get out, right? But they couldn't get out. They couldn't get out initially, right? They had to wait and wait and wait. So there's all these investors who are private investors, with these companies that once it goes public, they'll probably end up selling their shares and then moving the money to something else, right? Because we've seen in the past, usually the IPOs that came out, there's a massive, pump up and then usually a drop, right? We saw that with, Newsmax, I think last year. We saw that with Newsmax. We saw that with Circle. I think we saw that with CoreWeave. We saw that with a couple of companies. So he also mentioned that the long-term deficit path is a real concern. That's a real big deal. So just real quick, deficit, you know, the US makes this much money, but we're spending more than we earn. So that's the deficit. So, and we see that happening, right? The Trump administration just, again, I keep bringing these ones up because it's important, but the Trump administration wants to add another $500 billion onto defense spending. Okay. That is a big deal. You still have the OBBB, the one big beautiful bill that's, you know, really going to start to play a part this year. And you know, we're just spending like the US is just spending like we're drunken sailors. It's crazy how much money is getting spent. But you know, I mean, I guess the light at the end of the tunnel is, you know, there is a focus on reducing that debt. You know, right now, the United States is paying, I think, 1.2, maybe a little bit more than that, $1 trillion just on the interest. Okay, just on the interest for that debt. And the United States right now is at $38 trillion and counting, probably, you know, getting really close to that $39 trillion mark. The US has, let's see, he says extra latitude because of the dollar dominance, USD. So again, I talked about this yesterday. Right now, there's a memo, a potential deal, you know, out on the street that Russia, you know, will probably, hopefully, you know, probably cease hostilities in that whole region, but also come back and start settling everything in US dollars, right? So they'll be welcomed back into the, you know, world economy, to the global economy. You know, they're going to open up probably some of their lands to mining operations for, you know, miners, you know, so the United States can kind of get off this, you know, supply chain that China has a grip on, you know, for critical minerals, rare earths, all that other stuff. We talked about it before, you know, so that's going to just strengthen US dollar dominance. Don't get that twisted with the dollar being strong. But it, you know, right now there's a lot of financial warfare happening again in the broader geopolitical sphere between countries. You have the BRICS nations, you know, that want to basically move off of USD. They lost trust in the US government. They lost trust in US debt. You know, you had China dumping U.S. treasuries in, you know, in favor of gold. So they've been stockpiling gold. You have a lot of central banks throughout the world stockpiling gold. And now the U.S. dollar's, you know, dominance is kind of in question right now. So if this was to happen, this could be, you know, bad, you know, for the United States. But David Sachs, or excuse me, I keep calling him David Sachs, David Solomon, Goldman Sachs, they believe that the dollar dominance is going to continue. So I thought that was a really interesting. Those were just some of the key takeaways that I pulled up. And then this is also very important. The Golden Dome will power earnings for the defense, drone, and AI contractors, Palantir, Lockheed Martin, to name a few. And that is absolutely true. I don't even mention it. I always forget about the Golden Dome. But yes, the Golden Dome is still a thing, right? That's what the whole Greenland situation was about, on top of, you know, extracting, you know, minerals and all that stuff from it as well. But the Golden Dome is this massive project by the defense or by the Trump administration for basically creating missile sites and just having complete awareness, you know, space domain, land domain, ocean, you know, defense against rockets, right? So that Golden Dome is definitely, you know, a lot of benefactors, you know, companies are going to come from that, you know, so you can position yourself, right? And then just wait for the news. Palantir and Lockheed were mentioned. SpaceX was also mentioned. All right. SpaceX was also mentioned way in the beginning. I don't know if that's still the case, but SpaceX was mentioned when the Golden Dome initiative had started. So wanted to bring this up. I thought this was a really good one. All right, guys, I know we're moving on about 1 hour and 4 minutes. So let me try to finish off this stream real quick. All right. So Agnico Eagle, all right, plans a 20% to 30% decade-long production growth as cash flow reserves reach record highs. So this is a gold miner. All right. You guys can check them out. I just wanted to use them as kind of like a, you know, kind of an example here. Let's see. Yeah, so Al Jundy reported, we repaid almost $1 billion in debt. We built up almost $3 billion in cash, and we returned over $1.4 billion directly to our owners through dividends and share buybacks, all while continuing to invest heavily in our future through the largest exploration budget we've ever had and through continued investments into our 5 key projects. The CEO revealed Agnico Eagle's plan to increase production by up to 20 to 30% over the next decade, with a path to over 4 million ounces of gold of annual production by the early 2030s. All right, so again, big deal. Gold, if you're an investor in gold or an investor in miners, something to consider for your own portfolios. Again, Ray Dalio said people should have, with the debasement trade, ongoing, it's going to be felt eventually. It will be felt because Trump is going to run the economy hot. He's going to weaken the dollar. This will allow, other countries to purchase U.S. products at cheaper prices. He's going to run it hot. So the dollar is going to be weak. At least that is, the idea, or at least a part of the idea behind the debasement trade. So you're going to want to invest in real assets, things like gold, things that hold their value. Bitcoin, love it, hate it. It is a part of the debasement trade. You could also look at assets, real estate, things that actually produce a cash flow, right? Management reiterated a stable annual production profile between 3.3 million and 3.5 million ounces over the next 3 years, with 2026 cash costs forecast to be up a little over $100 per ounce compared to the last year, largely due to the higher royalties and a stronger Canadian dollar. So I put this up here because I want you guys to just be aware that if you're looking, because gold, GDX, which is a gold miners ETF, it actually had a pretty decent pump today. And the same thing with SIL. So these companies are starting their earnings season. Something to keep in the back of your minds if you want to do a swing trade, or if you want to get exposure or start a position in these mining ETFs. All right, because those fundamentals have not disappeared. Okay, those fundamentals have not disappeared whatsoever. Copper is still going to be extremely in demand here. Silver in demand. You can't have drone warfare. You can't have electronics. A lot of electronics without silver. So again, silver is an industrial metal, very, very important. Even though the paper price is not, cooperating, at some point it will. And I mean, what were people expecting, right? Just look at this chart. What were people expecting? Like this would just keep going up and to the right and never stopping, right? That was a very violent decline. But that was preceded by a very parabolic move. So we'll see if silver actually drops down to the $50 range. And I don't mean for the ETF, I mean like actual spot silver. But anyways, moving on from that, I thought this was interesting. All right, so this is Soros's fund. This is not George Soros's quantum fund. This is his family fund. Okay, it's roughly between $25-30 billion in assets under management. This is the fund that invests for George Soros and his family. Okay. And what did they do that was so important? They added or increased positions in Microsoft, NVIDIA, and Apple. All right. These are some of the names that have been getting a lot of, have just been getting hammered recently. Okay. There's a couple other increases in other positions. Exelon, don't even know who they are. Electronic Arts, which is kind of funny. It's a game. I'm sure you guys, if you've played Xbox, PS5, you know who Electronic Arts is. Atlassian, which is it's a collaborative like suite of tools. You can do collaborations. It's document repository. It's a CRM. It's a whole bunch of stuff. Speaking of CRM, they have Salesforce in there. And you have Uber, which I thought was kind of weird. But you also have them cutting Snowflake, the Circle Internet Group. Okay, Circle is behind the stablecoin USDC, right? That they had their IPO last year. We saw the stock rise exponentially, and then of course come crashing down. But they ended up cutting shares of there and Interactive Brokers. So I just thought that was really interesting. They initiated new positions, again, new gold. Digital Bridge, Blue Owl Capital, which is a asset manager similar to like a KKR or a Blackstone, Exact Sciences, and Excel Energy, among others. It exited Key, Care Trust REIT, Cipher Mining, and KKR. Okay, so again, I just thought that was rather interesting. What the big, basically what the big dogs are doing, what these big players are doing. So. For anyone who's, again, looking for signals, this is a pretty big one, I think, right? So anyways, moving on. we kind of already talked about it. We Anthropic going public, but they added somebody to their board, which is a big deal, because as Anthropic moves closer and closer to IPO, they wanted somebody, I think, that's going to help guide them through the regulatory stuff. But also they're getting someone who's an insider, right? Someone who's an insider. Whether this could translate to additional contracts with the government in the future, left to be seen. But having a former Trump administration official on their board is a pretty big deal, in my opinion. It is a pretty big deal. So just so you guys understand who this person is, Chris Liddell served as a CFO at Microsoft, General Motors, and International Paper. All right. These were all global companies, as you guys know. He was a deputy chief of staff and senior policy official in the Trump White House during his first term, working on strategy and technology policy. He led complex capital market and governance roles, including helping GM through its historic IPO, which is why he's been brought on for Anthropics. He holds leadership roles in major institutes and nonprofit boards, where he's able to utilize his skills in finance and public policy. So this is he's going to help Anthropic work through a lot of the regulatory risk, probably get them some federal contracts. Again, just that's I think is a big deal. So anyways, I just wanted to cover that because we're going to have, as the year goes on, we're going to see these IPOs come out. We're going to see Anthropic. We're going to see OpenAI come out. These are the two names that I'm looking at. Again, I don't know if I'll be the first one to jump in on an IPO. I don't want to get in and then, pay this crazy amount of money and then get like 2 shares, right? 2 or 3 shares, right? I don't want that. I'd rather lump sum in, like, if I'm going to dump in, it's going to be this lump sum and then I'll just let it ride out. I have not used Claude personally. I've been more of a ChatGPT kind of person. I'm a big fan of OpenAI and what they're doing. They're behind the Stargate project. If you guys know what that Stargate project is, really, really big deal. They're building a data center in the UAE. They completed a data center in Texas, Abilene, Texas, if I'm not mistaken. But they're building these massive data center campuses, throughout the world, and it all relates to the Stargate project, right? The American stack. American AI dominance, right? That's what the strategy is to build out all these massive data centers. And then you start getting into the power issues, where's the power coming from? Where are the chips coming from? Shortages with memory, and then yada, yada, yada. You can go down the list and then see who the benefactors of these data centers are, right? And where the money's going. You have the major hyperscalers, pumping $600 billion into data center CapEx or AI CapEx spend. Guys, I mean, there's everything to be bullish about when it comes to the AI trade. But of course, you're still going to have some of that news out there, some of that negativity out there saying that it's a bubble and it's going to pop. I don't know. The biggest risk right now is that circular financing. So that is it, guys. Let's see. Yeah, that's not really news. All right. So that is it, guys. I think I covered a ton. And I had not stopped talking for about 1 hour and 15 minutes. So I'm going to just check the chat real quick. So we have Sergio. He owns Cepi. Cepi's been a solid buy. And the reason is because SMH, the semiconductor space has been on an absolute rip this whole year. Well, pretty much, in 2025. It's continued here in this year, but if there is a major or a grind lower situation for the semiconductors at some point, there will be, or a correction. Cepi, it's going to have a harder time recovering, in my opinion, because people, again, I've talked about this before. They like to look at the April 8th. Oh, this is when Cepi, went down and it went back up. It recovered fast. It's like, it only recovered fast because the market recovered fast. If you had a very grind lower situation, a grind lower environment where we're just, like in 2022, where, it was an 8-month bear market, that could destroy something like Cepi, right? It's going to be hard because it's paying out a weekly distribution. And on the ride up, you're going to have capped upside, right? So, but don't get me wrong. I still think Cepi is a great fund as long as the semiconductor, space is doing well, right? So you have to really take that into consideration. Let's see. Yep, we covered this. Curve's K-Cop. It started trading today. So yeah, Curve came out with their new copper ETF. Again, that's a very small signal, right, for copper. Very small signal for copper. But we talked about copper and the demand is going to have. We've shown clips on this channel of some subject matter experts basically saying copper is going to be the next silver, right? Not in those words exactly, but you can kind of take away that copper is going to have an insane bull run. And it's a commodity super cycle right now, right? Everything's a super cycle, but there is a commodity super cycle going to play out this year. We saw it happen last year. A lot of the mining companies, just started climbing like crazy. Some returned 100%, within a month or within, like a couple of weeks. So it is going to happen. How will this impact MU's legacy? I'm glad Citizen of the Year brought this up. Let's check out the stats. Look at that. I'm up almost 4%, 3.5%. Citizen of the Year, man. You're not doing so hot, brother. Not doing so hot. This is how this will impact MU's legacy. Let's take a look while we're here. So I'm actually down by a lot. I am down by a lot. And again, for those new viewers, this is a challenge that we started in the community. So basically the idea is you get a hypothetical 100K. You can only choose stocks or commodity spot price ETFs like IBIT or GLD or SLV, and individual stocks only. No ETFs, no dividend ETFs, no high yield ETFs, no leverage ETFs, right? And basically the idea is you get 100K, allocate as you want, and we'll see who has the best portfolio by the end of the year, right? And there is a cash prize, or I should say a digital cash prize of 100 or 1,000 USDC coins, right? Which is basically $1,000, right? And that's paid out by me. So you didn't have to put in money in order to join this. Of course, this was all sponsored by me. So that's coming out from, yeah. So anyways, yeah, it looks like I'm down I'm down the most. We have Velocity Portfolio. He also runs a YouTube channel here. Yeah, he runs a YouTube channel. Recommend you guys check him out. Let's see. Theta Decay is doing pretty decent. Actually, you're pretty close, Citizen of the Year, to 100K. So you didn't really lose too much. You didn't lose anything, really. Let's see. Victor is mostly in the mining companies. Now, his port should really be up by 90 something. It's just one of the damn holdings just does not populate. The same thing for Evil Duck. Like if we look at Evil Duck's port, like it's one, I think it's this one right here. I really think it's this one that just will not really populate and give us that number. Because I added and re-added this whole portfolio and it does not update. Citizen of the Year is all in on MU. No, I recorded, yeah, the day that you put in for it. That's when I started the recording for it. So he went all in on MU. Let's see what else we got. Dividend Rocket, another YouTuber. Check out his channel. He's not down that much. Super Straight Guy, he's in the chat somewhere. He's down 4K. Some of his holdings right here. We went over the holdings. He has some gold, Costco, JP Morgan, IBIT, Amazon, CrowdStrike, Palantir, MSTR, Tesla, and NVIDIA. Let's see. Cereal beggar. It really should be cereal beggar. Like you're begging for cereal. He just used tickers that represent his name, and he's actually not doing too bad, which is so silly. Like he's actually doing pretty well. I would be so pissed if he actually wins this. He put no effort into it and he's gonna win. That would be funny. Anyways, guys. All right, I think that's gonna do it for me, ladies and gentlemen. Unless you guys got some questions, today is Friday, man. You guys got to get out, go have a drink or something. And tomorrow is Valentine's Day. Make sure you guys get your special lady or special someone, a Valentine's gift. Do not forget that. Sergio, yes, I already closed it. It closed on it was in the Discord. So we closed it on the 31st of January. So I'm not allowing any late entries. The working investor, he had put in for it. I don't know if he's still listening, but he had put in for it. But some of the, I think he had like 12 or 13 tickers. So TWI, if you want to submit that, you absolutely can. You still have time. And I'll just backdate it to when you initially put those in. Whoops. So bought some TSM today on the dip. Space-based data centers are next. Yeah, the Discord link is down below in the description of this video. It's under Stay Connected. You can sign up there, and I do that because I want to dissuade the bots from joining, because we had a lot of bots at one point, and I don't want people to get scammed. And just again, for anyone hearing this, if you're joining the Discord, understand that I will never direct message you. I will never DM you. I will never do any of that. There's a lot of scammers still in the group. I can't stop the bots. But if I message you directly, just know it's a scam right off the bat, unless we talk in the general chat and I tell you that I'm going to message you or something. But yeah, by and large, if it's me that's messaging you, it's probably a scam. Or excuse me, if a imposter that has my picture and my profile, look alike, is messaging you, it's a scam. I'm not messaging you. I gotta correct that. So Sergio says, bullish on this year on energy, memory, and semis. I am as well. I don't have any positions in energy though, so I'm not going to. I thought about dumping into some energy, but I don't know. I don't want to chase the way up. Like, if it's already climbing, I really still think we're gonna have some type of a downtrend, and I don't want to be in anything right now. I'm actually casually closing out some positions and then flocking everything back to cash. I did increase my BMNR holdings, like I mentioned earlier in the beginning of the stream. I did increase my BMNR. I did increase my IBIT. Yeah, so Sergio, it's not a Discord link. There's a link called Stay Connected in the description of this video, and you have to sign up for it because that dissuades a lot of the bots from joining, right? Because the bots would click those links and then just join. Like at one point I had like 100 join requests, publicly from YouTube. So I was like, I know most of these are bots, right? And I could tell like which ones are bots, at least for the most part. They'll have like a lot of dots in their names, or, their names just don't mean anything. Like there'd be letters and numbers. So yeah, I ended up deleting a lot of that stuff. Cool. You got it? Awesome. Well, I'll see you in the chat. I'll approve you as soon as I can get on Discord. All right. Well, ladies and gentlemen, I think that'll do it for me. I mean, I don't know if anyone has any final questions, any parting words. Appreciate that, tradesman. Yeah, please hit the link. All right. Or hit the link. Hit the like if you enjoyed this stream. It always goes a long way. All right. It allows the YouTube algo to pump these streams. And I enjoy doing these streams. All right. And I enjoy cutting it up with you guys. But with that being said, all right, you guys have a wonderful weekend, a wonderful evening, wherever you are in the world, or morning, depending on where you're at. And with that being said, I will see you guys in the next stream. I believe I'll be doing an invest and chill session on Sunday or Sunday night. So I'll be online. All right. And I'll try to be there for, market open whenever the overnight market's open. So hopefully we end the week really good. So we did have a poll, and I totally forgot about it. I always forget about it. We did have a poll at the beginning of this stream. That's asked basically, hold on a second. There we go. Do you think the changes will help WPAY, now called Top W, right? So we went over all of the changes happening for WPAY. So let's see. Out of all of you, we had 60% said, yes, finally, kick out the trash, referring to MSTW and COIW. And then 26% of you said, nope, WPAY is trash. All right. And then we had 14% of you saying, laughing in Neos investor. So I'm going to go with the I'm going to go with the 60% and say that, yes, I think these changes will absolutely help WPAY because, again, they're not going to include some of those lackluster performers like MSTW, and they're going to be rebalancing, I believe, quarterly now. And you have to meet the top 25 within the index, the S&P 500. And, you know, just looking at these, you could tell that some of these companies, UNH, Uber, I think, ARM, Coinbase, MSTW, are definitely not in the top 25. I don't think Costco is. It might be. Alibaba, I did see. Berkshire, I did see, and ABGO Broadcom, I did see them. So I think this could be a good change for WPAY. I'm very hopeful. But again, you know, that is what it is, right? I still hold on to my WPAY. I haven't sold out. But again, you know, maybe this will attract some of the investors that they lost. Only time will tell. All right, guys. Well, that'll do it for me. Let's see. Oh, I see. Okay, I see this question. I want to, let's see. First off, hey, I appreciate it, Gary. Always a pleasure. And you stay safe as well. Let's see. So Grab, I saw Pay Me in Dividends talking about this stock. I use Grab a lot out here. As a matter of fact, you know, because I'm in Southeast Asia, Grab is like the Uber Eats. I will say Grab is really, really nice. There's Talabat in the Middle East. Talabat was really nice. Grab is also really nice. As kind of like a boots on ground, like actual user of the app, I do like it. You can call your taxi with it. So it has like that Uber functionality. You can call it for food. You can get, you know, food, you know, groceries delivered because it has a lot of the markets, you know, on the app. So I do like Grab. Now, will I buy the stock? I probably will not buy the stock. I don't have that kind of a conviction in it. I know it's been in the press recently. It had a, you know, it had a merger and acquisition recently, and it's been doing well. Like all things considered, the business itself has been doing well. They've been kind of fighting with this other delivery company that's out here, but I think Grab just has the market share. As a matter of fact, I would say Grab has probably 90% of the market share here in Southeast Asia because you just see Grab drivers all over the place. Like Grab is everywhere. You see them on the motorbikes, you know, with a little Grab box and, you know, Grab helmet or whatever. Like I see them everywhere. So yeah, I mean, I like Grab. I mean, I like the company. I just don't know too much about it from a stock perspective. What type of investing do you do? So Anthony, I do, so like that's, I don't know, that's kind of a broad question. Like I don't want to focus strictly on high yield stuff. I like high yield investing, but it's not my entire portfolio. I think a lot of high yield investors have learned the hard way that you can't full port into some of these things. I think if anything, it should complement your portfolio. And you know, like you can see some of my older videos. You know, I've invested in high yield. I also have growth ETFs, or I had growth ETFs. I have metal commodities positions. I like to invest on trends or macro, right? I like to invest on macro theses. So like something like the debasement trade, or the AI trade, or, you know, the data center CapEx, or, you know, things like that. Like I like to invest based on macro themes. That's more so probably my style of investing. Like if you told me to do due diligence on, like, I don't know, let's say due diligence on Grab. Like if you ask me, like if I don't have any interest in the company, I'm not going to do due diligence on it. Like I have to have interest in it. And AI, because of my technology background, and I use AI every day, I understand that AI, this like AI revolution is probably like as important as the industrial revolution, right? We had the information age, completely changed the way of life. We have email, right? We had the boom of the internet age, and now we have artificial intelligence. Like you couldn't think of artificial intelligence 5 years ago. Think about that for a second. 5 or 10 years ago, nobody would have thought of artificial intelligence, right? It was always in the movies, and now we have AI used every day on a cell phone. Right? It's like we're growing up with artificial intelligence and we don't think anything of it, but people are discounting how important artificial intelligence is. We already see it happening. Jobs are getting cut. Jobs are going away. You know, then we're going to have physical AI, you know, taking, again, that is coming for sure. So, I I like to invest on themes. I always used to be like a real estate investor. I was a pure real estate investor, rental property investor. Then I moved on to real estate investment trusts. I really liked REITs compared to rental properties because you're not going to have a crackhead do coke in or do crack in your your REIT. And even if they do, you're not going to hear about it, right? So I liked that aspect. I did some commercial real estate investing, so I have that under my belt. But I moved kind of away from that. I was a strict index-based investor. Just that was my equity position. That's all I had. And then, as I started to really like dive into this stuff, really dive into investing and trying my best to understand everything, then I started to do my own, positions, my own convictions, like things like MSTR, BMNR, nvda, Palantir, Robinhood. That's how kind of I evolved as an investor. Real estate, I like real estate. I still believe it is a great wealth builder, but since I don't live in the United States, rental properties just don't make sense for me. I could invest passively in REITs. I like REITs. There's Fundrise, for people who don't want to do due diligence on individual REITs like Avalon Bay Communities, Sun Communities, American Tower, DLR, Digital Realty Trust, Triple N-O Realty, etc. I can name them all. But for those who don't want to do all that due diligence, you can always do something like a Fundrise, which is crowdfunding. But that just gives you exposure to real estate. So yeah, that's kind of how I approach my investing nowadays. I'm just going to have my highest conviction picks, and that's it, or sectors, and that's it. I'm kind of done with hopping from ETF to ETF. A lot of people, like I did that last year, and the biggest mistake, right? Biggest mistakes I made last year was hopping from ETF to ETF, adding to or initiating positions and things I shouldn't have, playing too much with the damn leverage funds, and I don't mean the weekly pays. I mean the like the 2x bull shares or 2x long, right? Or shorting or whatever. Like I played around too much with that. So now this year I'm trying to focus in on my highest conviction picks and just let them play out, right? Just let them ride and see what happens. But I still like the high yield space. I still do. I just don't want to cover it all the time because, I mean, we look at it. If you look in hindsight, of course, everything is 20, in hindsight, but there was a rush to these high yield ETFs because we had this, belief they were going to pay forever. Life is good, right? People not fully understanding what they were investing in and then getting absolutely wrecked. I just got so tired of the space because of that, because it would be like a rotation. Everyone loved yieldmax until they didn't, until like people were like, oh, NAV erosion. And people still don't understand what NAV erosion is, even though there's like 100 videos on the topic. And then, oh, you're getting paid your own money back, return of capital, blah, blah, blah. It's like, okay, real estate, you get ROC. And why is real estate ROC favorable versus investing, right? In equities? Why are distributions that are ROC suddenly your own money back bad, right? That gives you actually an advantage to move the money into a different asset, right? That's what real estate people do. Anyways, off that rant. It became too much. Like in the high yield space, there's a brand new ETF every other week. There's a new launch, a new something, a new strategy, a new this, a new that. And honestly, it's too much. I'd rather not cover that. I don't want to make that a full-time job. There's some channels that do great work on that stuff. Shout out to a couple of them. You have Income Architect, you have Spencer, you have Marcos, you have Pay Me in Dividends, you have people who do more like strategy-based stuff. You have people like Dividend Rocket. You have all these other YouTubers that do great jobs covering the high yield space. Me personally, I don't want to be just known as the high yield guy. Personally, I'd rather cover macro news and things that are important to me, right? Things that are important to my portfolio. Because again, you saw the shift. You saw the shift, and I'm going on a really long tangent here, so I apologize, guys. I should be cutting the stream. But we saw a huge shift from yieldmax, and then when people started hating yieldmax and they went to Roundhill, right? Oh, Roundhill is great. It's uncapped upside. It's going, everything is good. And then when we ran into problems, volatility, the market going down, now it's, oh, I got out of that garbage. You know, Roundhill is trash. It only returns your money to you. The leverage is bad and there's no leverage at all and blah, 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 right? And now everyone's flocking to Kurv and Neos. Oh, these are the safest ETFs. These are the best, no NAV erosion, et cetera, et cetera, et cetera. And then you also had fund managers taking advantage, and rightfully so. I mean, you know, they're only listening to the market. Coming out with funds that have new strategies, right? Hedging, protection to the downside. They're going to be in and out of certain things. They're going to swap. They're going to do auto call. All these new strategies started coming out, right? And there's just a new ETF that has a new strategy every other week. And honestly, it just got to be way too much. I think it turns into noise, right? It turns into a noise for a lot of people. And I get it. There's always going to be someone that has a question about these ETFs, right? Especially someone who's coming into the space brand spanking new. So, you know, I get why the content should be created. You're also going to have bad content out there, right? All in, right? Go all in on msty, all in on ulti, all in on WPAY. And then those channels basically no longer talk about those ETFs. So, yeah, anyways, to answer your question, Michael, that's very long-winded, but to answer your question, my style of investing is based on macro themes. I like to invest in stories. I'm more of a qualitative type of investor versus a quantitative, someone that does more like fundamentals. Fundamentals are important. I do, research the fundamentals as well, looking at, how much debt, income, revenue, all that stuff, listen to earnings reports, that kind of stuff. And then I come to my own conclusion. But that's really how I do my own investing. Man, I went on a huge tangent. I am sorry, crowd. I'm sorry, chat, about that. Referring back to Grab, yes, there are competitors. I don't know those competitors off the top of my head, but I do see Grab everywhere. How broad? I'll say it's very saturated. Here, I went to the Philippines. I see it in, I think, Vietnam. I thought I heard people talking about it in Vietnam, and then in Thailand as well. Grab is pretty much everywhere. Like, you cannot drive anywhere without seeing Grab. Grab just reported earnings and selling off. Yeah, I saw that. I don't know what happened. When W top, mom. They should have called it W top. I don't know why they went with top W. It's like top G. They should have just called the ETF top G. Let's see. AI has been around since 1980. All these layoffs is because of AI, but mostly because of a slowdown that I heard on the earnings call. I mean, yeah, there's iterations of AI, but this iteration of AI is obviously the most advanced. The AI that was in the back is just really it was a joke in the programming space. Like all the AI in the back, at that time was just a bunch of what if statements. Yep, Neos ETFs has a good real estate ETF called IYRI, if I'm not mistaken. All right, ladies and gentlemen, I have been chatting. I really have to get going. I do appreciate you guys joining me for the stream and hearing me rant on and talk trash. I do appreciate you guys. You guys have a great weekend. All right, great rest of your day, and I will see you guys in the next stream. You guys take care.